That was a very interesting presentation from Adam, and certainly our analysis agrees with a lot of the key messages that were put across there. We also very much welcome the recommendations made in the Wood Review earlier this week. The UK is really at a crossroads at the moment. We've seen huge production and exploration underperformance, so anything that tries to improve the situation has to be welcomed. However, the key for us to the ultimate success of the Wood Review really lies with companies balancing what can often be competing aims between acting in the interests of shareholders versus acting in the interests of the UK PLC. So today what I wanted to do was really put some of the recent performance that we've seen in the UK into context, primarily by comparing it with Norway. So I'm going to take a look at an area that we've been doing particularly well in, investment, and then I'll take a look at some areas where we've been quite frankly struggling, so production and exploration performance. So the North Sea is going through a boom phase in investment at the moment. And this chart, the map on the right, shows investment by country globally. Now, I think one thing that's really positive is that the UK ranks within the top 10 destinations globally for capital investment. The ramp up that we've seen in spend in the UK, though, over recent years isn't an anomaly. It is in line with global investment trends. And that's really a result of high oil prices giving companies confidence to progress projects. The spend in the UK is still dwarfed by spend in Norway, which is proving a much more popular destination for capital investment in the North Sea. Now, the higher cost environment in Norway does account for a portion of this, though. In terms of where the spend's going in Norway, last year 70% of spend went on producing fields, and a sixth of total capital investment went on Ekofisk alone. We are, however, seeing more new projects coming into the mix in Norway. Companies are working some mega projects at the moment and investing in those, so things like Polar Lead, Edvard Grieg, Martin Linge, for example. And this is really changing the risk profile of investment in Norway. Now, one key difference we see between the UK and Norway, though, is really on the visibility of the future project pipeline. So we estimate there's been 260 million barrels of oil equivalent discovered in the UK since the beginning of 2011, which doesn't lead to many projects coming through the pipeline. In Norway, it's quite a different story. Now, to show that companies are working on much more costly projects, I'm showing here the capex per barrel of new field developments sanctioned in the year that they were sanctioned, and you can see that for both the UK and Norway, there's been a sharp increase in that. Now, cost inflation does play a part, but in the UK, it's because companies are progressing much more technically challenging and therefore much more costly per barrel projects. Now, the cost inflation that we're seeing across the North Sea is being particularly acutely felt in Norway. It is a much more insular market with a bit more of a stringent regulatory regime, and that's really stretching company and service sector resources. In addition, higher rates of tax in Norway are fed all the way through the supply chain, and that does have an impact on upstream economics. Now, all of this activity in Norway has led to the sector overheating, and last year the Norwegian government brought in its first negative tax change for industry in more than 20 years by reducing the amount of capital uplift available. Now, there were already some very marginal high-cost projects in Norway that have been particularly impacted by this, and there are signs that we may see some tax breaks being introduced for these types of projects in a similar way to what's been happening in the UK. But new developments are struggling. So these charts show Wood Mackenzie's probable developments. So by probable developments, we mean projects that haven't yet been sanctioned, but which we believe will be sanctioned and companies are actively working on. And what I've done is I've plotted the break-even oil price required for each of these projects to generate a 10% rate of return, and it's against the cumulative reserves within the portfolio. I think what's particularly concerning is the fact that 3/4 of reserves in the UK probable portfolio don't generate a 10% rate of return at $65 a barrel, which is Wood Mackenzie's low case price assumption. and it was where Brent was just a few years ago. Now, this 3/4 of the portfolio includes important developments like Rosebank and Bressay, which have already been delayed, but it also includes the important HPHT projects Culzean and Jackdaw. Now, at face value, things in Norway look better, but the y-axis is very different. So even though it's only a quarter of reserves that don't generate 10% of rate of return at $65 a barrel, that's still 1.3 billion barrels of oil equivalent, which is almost the same size as the entire UK portfolio. And again, projects like Johan Castberg, Zidane, all lie in that bucket of very marginal projects. And in Norway, if we continue to see the increasing cost pressures that we've seen, there is a real risk that some of these projects won't go ahead. Even though the UK is a high-cost environment, it's still possible to develop sub 50 million barrel pools of oil commercially on a standalone basis. In Norway, this just wouldn't be economically viable. Now, all of this investment does lead us to have a positive outlook for production, both in the UK, where we expect the long-term production decline to temporarily halt, and in Norway, where we're expecting production to remain fairly stable. But we do see significant downside risks to this forecast. The UK's undergone a few years of significant unexpected production underperformance. So this is Wood Mackenzie's forecast for total UK production from 2009. And this is what's actually been delivered. So that's a shortfall in 2013 of 670,000 barrels of oil equivalent a day compared to what was expected just a few years earlier. Now this is huge. It's the size of trawl production for 2013. So we're effectively missing a trawl from UK production in 2013. Now, we estimate that about 10% of the shortfall comes from Elgin, Franklin and Rum being shut in. About 2/5 of the shortfall comes from delayed new field developments and some new field developments not coming on initially at rates that were expected. But concerningly, half of all the underperformance comes from fields that were already on stream. So they're either declining more quickly than expected, we're seeing more maintenance being carried out, there's poor operating efficiency on some of these assets as well. And this is how Norway's fared against expectations. So Norway's produced much more in line with expectations. Now that's not to say that there aren't production issues on assets in Norway, because there are. It's not an easy industry to work in. There are, of course, challenges to producing offshore. It's just that almost half of all Norwegian production comes from 5 fields. So as long as those fields produce to plan or can increase production when others aren't, then overall production from the Norwegian country comes in line with expectations. In the UK, we don't really have that element of swing production. Now moving on to exploration, the UK does rank within the top 25 countries globally for reserves discovered over the last 10 years, conventional reserves discovered over the last 10 years. But I would urge a note of caution around this. Less than 1/3 of the 2.5 billion barrels discovered have been discovered within the last 5 years. Now, performance in Norway has been outstanding, with 9 billion barrels oil equivalent discovered, and this has been across the Norwegian shelf. Now, to compare activity between both countries, it's unfair to compare both countries in their entirety. There is no equivalent to the Barents in the UK. So what I've done here is just compared the central North Sea and northern North Sea sectors for both regions. And in doing that, Norway does still outperform in terms of exploration performance. So the actual number of exploration wells drilled over the last 5 years is higher in Norway, so 121 exploration wells in these sectors versus 87 in the UK. The volumes discovered are far higher, not surprisingly considering Johan Sverdrup's in there, but it's 10 times the volumes discovered in Norway compared to the UK. But even without Johan Sverdrup, it would still be 4 times the volumes discovered, and the success rate is far higher. Norway exploration success rate in these sectors is 47% over a 5-year period, which is actually outstanding on a global scale. In the UK, it's 35%, which is still in line with global exploration success trends. So why is it that in two sectors that are broadly comparable, the UK doesn't perform as strongly? Well, exploration maturity plays a large part. If we take a look at drilling density in these areas, there's been one exploration well drilled for every 67 kilometres squared of acreage ever licensed in the UK Central North Sea and Northern North Sea. In Norway, the same statistic is one exploration well for every 133 kilometres squared ever licensed. In addition, even though companies do believe in the prospectivity of the UK, they're struggling to get access to the rigs to drill. And some companies, particularly those with large global portfolios with a wealth of exploration opportunities, are struggling to get the internal capital allocation to explore in the UK. And for those smaller companies who would normally attract investment from the market, exploration in the UK has really fallen out of favour for some of those investors. In Norway, there is a real buzz around exploration activity, particularly because of recent success. But still, a lot of the exploration activity is being carried out by Statoil and some of the smaller mid-sized players. Now, some of these smaller companies are really pure exploration companies who find it much easier to operate in Norway because of the fiscal regime and the ability to attract finance to explore there. But the success hasn't been homogeneous, and some companies have struggled. In addition, there are significant challenges in Norway to commercialising your discoveries, particularly if you don't own the hub infrastructure. And even though there is a 78% exploration tax rebate in Norway, you have to remember that you're paying a 78% marginal rate of tax on any barrels you produce, so that does impact the development economics. Now, if we take a look at value creation through exploration, it hasn't been particularly stellar for the UK. So in terms of what we mean by value creation through exploration, we take a look at all exploration and appraisal spend in a basin and the value of discoveries made, and then we get a net value created number. So for $23 billion of exploration spend, we see net value being created of $7 billion. But the success has varied by basin. We don't see any value having been created in the west of Shetlands. Some of the exploration decisions that would have been taken in that particular region would have been taken in quite a different environment. So we've seen a couple of tax increases that have eroded value from some of the discoveries, and we've seen significant cost escalation on some of the projects there too. The majority of the value has been created in the Central North Sea and Northern North Sea, where some companies have had success in near-field infrastructure, near-field exploration, and being able to tie back any discoveries to their own host infrastructure. And the picture is actually pretty similar in Norway in terms of where the value is being created, with the majority in the Central North Sea and Northern North Sea. Now, even taking Johan Sverdrup out of the Central North Sea numbers, you would still see significant value creation. There has been limited value created in the mid-Norway and the Barents, largely because of its remoteness and lack of infrastructure. And exploration in these regions really is a game for larger players, much better able to withstand high levels of upfront capital investment and longer payback periods. And to end on a more positive note, we believe that there's still plenty to pursue in the UK. So we are estimating about 4 billion barrels of oil equivalent of yet to find reserves out to 2020. And that's in addition to the 12 million barrels of remaining commercial reserves and technical reserves. So that's a quarter of the UK's overall potential yet to be produced. And much of this is in areas with existing infrastructure, which should make it easier to commercialise, at least if the aims of the Wood Review are met. However, this does rely on companies drilling and developing, which in turn relies on companies securing access to finance, either from external investors or through internal capital allocation processes, which has been a challenge over recent years. So to summarise, we are going through a boom in investment across the whole of the North Sea, but project economics are being squeezed by the high level, by the cost escalation that we're seeing, and some projects are being put on or have been put on hold already. Bressay, Rosebank in the UK, but Johan Castberg in the Barents. There is also much less visibility in the UK over where the next wave of projects are going to come from compared to Norway. We do expect the investment to have a positive impact on production, but there is significant downside risk to this for the UK, particularly given the recent production underperformance that we've seen over recent years. And despite recent exploration underperformance, we do believe that there is still a lot of potential in the UK, but it does rely on companies exploring, and ultimately it relies on them having confidence in the subsurface and the ultimate commerciality of any discoveries in order to progress that exploration. Thank you.